benefits. Of course, it would have made a big difference if they had, but it's a matter of few months, and I'm just hoping that it's done at that time.
Well, matter of few months. That was Anshuman magazine talking about how the government was pretty confident in its announcements, and one of the 2 to 3 significant announcements that were done were actually being appreciated by the industry here. Of course, the industry, on the contrary, looking to have some tax breaks or some relief to ensure affordable houses are constructed without any hindrances. Thank you, Anshuman, for joining us.
Thank you.
Pleasure.
Hello from the India Today Group studios, and a very warm welcome from Business Today Television as we continue to analyze the fine print of the interim budget 2024-25 and one more set of budget makers. This time to my left, Dr. V. Anantha Nageswaran, the Chief Economic Advisor. To my right, Mr. Sanjay Malhotra, the Secretary of the Department of Revenue. Welcome. Dr. Nageswaran, I start with you on the time that we have with the first question. What's your message to rating agencies after today's interim budget numbers?
The numbers tell their own story. I mean, we don't have to give a specific message. I think before this budget, they were saying that the path to 4.5% was challenging, and we have shown that we are not only committed to the challenge, but we are delivering on them. I don't think there is one can be more explicit than the gross fiscal deficit projection for FY25. That is the most explicit message to them, that we are committed to the path of fiscal prudence. Our fiscal fundamentals, both in terms of nominal GDP growth and interest rates, are very much making our debt sustainable. So the message is very clear to them.
And along with that, the pre-budget aspiration 7% growth target, and again that received a lot of commentary, and some people asking how will this happen. Now that the budget is over, can you just add on to the growth aspiration of 7% and where you seeing that being delivered from?
In FY25, I think we are going to continue to see a pickup in private investment. And what happened, and I think this is not well understood, and I think RBI's claims database shows that COVID basically came in the way of absorption of surplus agricultural labor into Indian manufacturing, which was beginning to happen, and then COVID came, and then we had a reverse migration. But what you see in the claims database of RBI, which unfortunately is now available only up to 21-22, the reversal of the reverse migration actually commenced in 21-22. So we are going to see further creation of manufacturing employment. Go and look at the data in RBI website. Manufacturing added close to 2 million jobs in FY 21-22. So I think the movement out of agriculture, the surplus labor, getting into manufacturing and services is something that has picked up steam in 21-22, and once we see the data in 23-24, etc., you will see it continuing. So this is going to generate employment, which in turn will generate income growth and consumption growth. So I think we are going to see both investment and consumption engines of the economy propelling us towards a growth rate somewhere between 6.5% and 7% in FY25.
So consumption and investment, the double engine. Before I go to Mr. Sanjay Malhotra, one quick follow-up, and this question relates to Manrega in response to what you said. If workers are going into manufacturing and more absorption is happening there, explain the increase in the Manrega allocation.
I think this point was raised in the press conference, and the Finance Secretary did answer it. The Manrega allocation is the same as the revised estimate. Okay, there is no change in the Manrega allocation in the budget for FY25, and it is a demand-driven program. And also, the Finance Secretary correctly pointed out that the CAG has come out with several observations on the way some of the Manrega claims are generated in several states. So, in fact, I would say from a macro perspective, based on what the observations made by CAG, what we gather is that if Manrega demand is going up, it is not necessarily a sign of rural distress.
Which was my...
On the contrary, if Manrega demand is going down, it is definitely a sign of rural buoyancy. So what we are seeing is that Manrega demand in FY23-24 is not running at a level above the previous financial years.
Okay, I'll come...
If I may
yes,
add to it, the employment, the people, in the employment range are also increasing.
Yeah.
Even though, the population may not be increasing so much, but the labor force is certainly increasing. So
you have to cater to that.
So you have to cater to that as well.
Ms. Malhotra, I want to pick up that one question which is being spoken about, and you might have already answered it. Why is the 15% lower corporate tax rate that was extended to companies set up after the 2019 date not being extended beyond 31st March 2024? Is it sunset for it, or is there scope for reconsideration?
No, that scheme obviously, if it doesn't find a mention, obviously, that is a sunset. But that's a sunset for a valid reason. And that is, industries take long period of time actually for the investments to fructify. So if you are going to extend it, for 6 months or 1 year, it actually really doesn't make any difference, any impact. And this is an interim budget. So you can't, extend it just for 1 year, because investments, they take time to, first of all, conceptualize, then, to do the financial closure, put them on ground. And so, and this was the year, that it was required to sunset, and so it has.
Okay. The big headline, no changes in taxation, running all across media. Explain why, because there was a run-up of expectation, Mr. Malhotra, consequent also to what happened in 2019.
There were huge changes, large changes, which were made in the budget last year. Should we be expecting those kind of large-scale changes every year? And it's an interim budget.
Yeah.
And the Honorable Finance Minister has mentioned, that's rightly, the convention that we should not, of course, in 19, some tweaks were made. But major changes were made. You are aware of them, we discussed them. I need not go into details.
Absolutely.
And it is primarily for that reason that no major changes were announced, because 1 year ago only, the exemption limit was increased, from 5 lakh to 7 lakh. The new tax scheme, that was simplified, rationalized, number of tax slabs were reduced. Similarly, benefits given, to the non-government employees in terms of the gratuity amount being extended, free without income tax, being extended from 2.5 lakh to 30 lakh. And so it was not, so there was nothing left actually, to be done in this budget.
Okay, not even from a point of view of inflation biting into household budgets?
I don't think, the the taxation rates have been changed year on year basis every year. Is it, periodically, 3, 4, 5 years?
So that I would like to comment on, come in there on this question about inflation and the taxation. That's precisely the reason why the PM Garib Kalyan Anna Yojana was extended for 5 more years. And I think the inflation indices measure the food price changes, but not exactly what the public is paying, because 800 million people or 80 crore people are not paying anything for the food grains, and that is, and so therefore in that sense the statistical inflation rate overstates the inflation rate. And also, if you don't mind, I would like to comment on the question that you posed to my colleague Sanjay on the sunset clause on the special tax dispensation for new manufacturing entities. I think the scheme, when it came in 2019, was very clear. It was meant for a period of 3 years, and then because of COVID, it was extended. I think the problem is that even when the government clearly gives an indication that something is not for eternity or perpetuity, the expectation somehow builds up that it will be for perpetuity. But Sanjay made a very excellent, important point. Sometimes it is good to end the uncertainty rather than keep extending it for 3 months, 6 months, and 12 months, because I think businesses like the certainty rather than a continuation of a particular facility for limited periods of time without knowing when they will end, when they will not end. So I think therefore sort of drawing a line is actually far better.
No, and I completely, hundreds of crores and thousands of crores for projects cannot be invested just on the account of some tax arbitrage. I completely buy that point. Let's turn to a broader point, and which is the macroeconomic framework and the signal of continuity, reform and stability that many other parts of the budget have pointed out when it comes to the deficit, the borrowing figure. In fact, that is likely to allow private sector borrowing costs to come down. Between the two of you, and I come to you again, the macroeconomic framework including inflation, is this the best that we could have hoped in a global situation which is quite uncertain?
Yes, I would think so. I think the way we handle the economic and the health fallout of COVID actually set the stage for both a growth rebound and inflation rate peaking at well below 8%, which is what it did in the first quarter of 22-23. And then it has been generally hovering between 5 and 6% by and large. And I think, and the fact that the government basically cleaned up balance sheets of the corporate and the financial sector is also paving the way for growth to realize. And the investments in infrastructure in general are improving our supply side. I think, as Dhammakriti Joshi of CRISIL wrote this morning, our economic growth cycles have been more of sprints than marathons in the past. And what this government has done, despite the COVID setback, is to make sure that with its capex policy, it is going to turn these sprints into marathons.
Okay, that's a great line. We were talking about tax. I must also point out that tax policy is multi-year, decadal, and one of the things that has been done and announced is the disputed tax demands up to a certain level being done away with. Is it like cleaning up the books and saying past is past, let's start on a new note with, especially with the smaller taxpayer?
Yeah, primarily see, these tax demands have been on the books for a very, very long period of time. Some cases up to 60 years. Many of these tax demands are very, very small. Many of these tax demands are actually fictitious. They do not exist because our record keeping has not been up to the mark. And so in interest of everyone, the finance minister thought it fit that we withdraw these demands. As I mentioned, most of these demands are actually not going to pay off, and the total amount is also not very high.
Okay.
We have about 2.6, to give you a perspective, we have 2.68 crore demand entries as of now, roughly 2.68 crore demand entries, which amount to a total tax outstanding demand of 35 lakh crore rupees. Now these tax demands are these are about 1.1 crore, about 50%, 40% of these 2.68 crore demands, but they amount to less than 3,500 crore, which is less than 0.1%. But it cleans up, our books. We are able now to focus, on the larger demands, on the demands which are actually material. And in terms of cost-benefit analysis, it is prudent, that we concentrate only on the larger demands.
Absolutely. Continuing granular taxation reform. We are running out of time, but I'll take one question with both of you, and it relates to what the government sees and you yourself see in terms of the private sector contribution, because the government continues to drive the capex engine. How long can it do so? And then subsequently to you, with the tax changes in 2019, do you see that engine firing? But I'll start with you, sir.
Very simple. Private sector is beginning to invest, but it can and should do more because its balance sheets and financial situations are far healthier than they ever were. And I think they should step up their game on investments. And second, they should do their best to pay MSME suppliers on time. That is what will create sustainable growth. These are the two expectations of the private sector.
And with the banking cleanup also, the private sector.
That's exactly the point I made. The private sector is now not only flush with its own resources, but the banking sector is willing to lend as well. And all that they need to do is to invest, because if they believe in what they say about the long-term future of India being extremely bright, then they should put their money where their mouths are.
And the final point there, 2019, that big tax rate cut and the expectation in manufacturing that it will yield results. Do you think now the stage, at least because of the COVID interruption, is where the private sector has to come out with all guns blazing?
No, absolutely. I agree with Anantha. I mean, this is the best time for them to come in because, their balance sheets, they are flushed with funds. The banking sector is all, cleaned up. The gross NPAs are about 3%, less than 4%. So this is the best time, for them to come in. The tax rates, as you pointed out, very, very reasonable. And we are getting, and we have, the PLI scheme which has been brought in. The import duties, have been aligned with the PLI schemes to give, some kind of a push to our domestic manufacturing. And we are seeing signs of it. A lot of electronics, coming in, a lot of exports also, being generated, mobile phones, etc. So I'm pretty confident that private capex should also increase.
The confidence, clarity and cohesion that we have seen in Modi government budgets visible once again. This was an interim budget, and I know that with the full budget in July, we'll get opportunity to speak again to the budget makers. Thank you, CE, and thank you, Revenue Secretary, for your time with us today. With that, it's a wrap. We'll be back with more. Do stay with us.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors. In today's rapidly evolving business environment, when risk is omnipresent, managing risks is no longer just about ticking a few boxes. Businesses need to maintain a panoramic view of risks to stay ahead of the curve. Join us to explore how organizations can rethink risk to unlock new possibilities and become fit for future. At PwC presents De-Risking the Future in collaboration with Business Today. Celebrate 32 years of leadership in business news with Business Today. From the groundbreaking AI cover of Sundar Pichai to PM Modi's exclusive on G20, we redefine headlines. Now our 32nd anniversary issue explores India 2029, the 5-year agenda with industry titans sharing exclusive insights. So, just BT it for unparalleled perspectives. Business Today, 32 years of leadership, innovation and business brilliance. Subscribe now.